And I have 1 hour, right?
Yeah, exactly. I'm not sure about US cultures when presenting in a seminar, but actually when I was in Germany, like some people also try to interrupt and ask a lot of questions sometimes, and like the speaker doesn't have enough time to go to the end of presentation, but actually
No, yeah, I think it's presenters' job to make sure he or she says whatever he or she wants to say. It's not audience job to control the time. It's my responsibility, right? In the US, we typically have 1 hour and a half or an hour and 50 minutes. But let's see if I can get through within an hour. And I think the audience just woke up, right? So you guys are fully have the full energy there. All right, so let me start. Good morning, everyone, and thanks, Toan, for inviting me to give this presentation, and thanks everyone for coming as well. So today, I'm very excited to share with you some of my, actually this is my new paper. If you go to my website, you'll see I highlight this my new paper about international risk aversion propagation. It's co-authored with Xin Huang from WashU in the US. And I myself is an assistant professor of finance in Boston College, okay? So I would like to start this presentation with this plot. This plot shows you this time-varying risk aversion that is filtered from my other work with Geert Beckert from Columbia and Eric Enstrom from Federal Reserve Board. So in that paper, we filter a time-varying relative risk aversion from a variant of the Campbell-Cochran habit formation model. So that's why the unit is relative risk aversion that satisfies a wide range of dynamic asset prices moments, as well as the fundamental variable dynamics. One of the main points about this paper is that US risk aversion seems to be more extreme or kind of extremely time-varying than what a standard theory would suggest, which either uses constant risk aversion or uses a very persistent risk aversion, right? And just look at some episodes here. We have this Asian crisis, this war events initiated from US and 9/11, right? And then this Lehman Brothers aftermath, European debt crisis. And recently we have 3 shocks in the US risk aversion after the COVID. We have the first time the COVID was declared in March. We have the US election, not surprisingly, that caused a lot of fear and anxieties in the market. And in January this year, 2021, there's another fear because of the new variant from UK. So this plot is, I think it's quite interesting. Again, the main takeaway from this paper was that there's a strong time variation in the risk aversion in the US. And just to put it in the context, right? For decades, the time variation in investor risk appetite has been widely discussed and examined, including the work I just showed in the first slide. But just to have a bigger picture, the behavior finance literature, and there's micro evidence using surveys or experiments, have shown that risk aversion is time varying and countercyclical, meaning it is high during bad times, right? That's quite intuitive. And there's another branch from the structural asset pricing framework where, we have this habit formation model assuming time varying relative risk aversion. And we have papers showing that assuming a time varying risk aversion, or specifically countercyclical risk aversion, can help explain some of the important features of equity risk premiums, for instance, the fluctuation, and as well as the level. And then there's another literature, reduced form asset pricing literature, where they try to filter a time varying price of risk from stock and option asset prices. And now I spent a fair amount of time introducing you to this literature. Why? Because we know very little about the cross-section, meaning we know very little about how investor risk aversion may respond in international context. Because before, in its literature, we understand very well how risk aversion change over time within one country, but we don't know how investor risk aversion may respond in the international context. So this is the question I'm after in this paper. Okay. Now, even though there's no kind of a very little research on kind of a risk aversion propagation, how they can move across countries, there has been papers showing that and arguing that the existence of a global risk aversion, global risk appetite, can potentially explain some of the important patterns in the international co-movements and the global financial cycles. And we have these empirical identification challenges, of course. One of them is obviously the measurement. What measures this country level aggregated risk aversion? That is an ongoing debate. And because risk aversion is a latent variable, meaning, ideally, I can send surveys around, right, every day, and you fill out the survey of your risk aversion and send it back to me, but that's not realistic. So usually we have to filter it from some risk premium or observable asset prices. Now, what drives the risk premium is the other main component. For instance, uncertainty. I know you have heard Scott Baker's presentation a couple of weeks ago, right? So his research focuses on uncertainty, and that's exactly what we wanted to tease out to get this risk aversion measure. The other difficult challenge of understanding and answering this question is the country origination of the shocks, right? Meaning how local risk aversion can become a global risk aversion, and how does that propagate? And last but not least, the final challenge we have is the literature hasn't agreed on a comprehensive list of risk aversion events, because otherwise we could just use them and study the propagation using event studies, right? So in this paper, we want to fill this knowledge gap by studying how non-US risk aversion responds to US risk aversion events, and through what testable mechanisms, that is how US risk aversion propagates to other major developed economies in this paper. And the presentation and the paper have two components and sections. The first section is where we establish the pattern of risk aversion propagation using actual financial market and news data. And the second section and the second part of this presentation as well is to show you the evidence of potential mechanisms that we can test in a controlled experiment. Okay. So that's basically the layout of the structure of the paper and also the motivation of the paper. And as usual, in the seminar, speakers give a couple of slides of the preview so that the audience can just take the results and remember the results without, forcing yourself to pay attention for the rest of the talk. Now, so the preview of our results, number one, the pattern, right, that corresponds to the financial market and news data evidence. The identification, so we provided the high frequency evidence of how US risk aversion propagates to other countries through an event study analysis. You may wonder, okay, so why don't we just run regressions saying how one country's risk aversion, regressed on the other country's risk aversion? We cannot do that because it doesn't provide a causality conclusion or directional inferences, right? Given the confounding factors we have mentioned above. So our identification strategy starts with a very simple empirical proxy for daily country risk aversion. So we use this variance risk premium, this concept, to be our empirical measure of daily country risk aversion. So for those who don't know what is variance risk premium, essentially that captures the the excess price you are happy to pay to have a hedging position against the future stock market variance, right? So intuitively, if you are more risk averse, you are happy to pay more to have a hedging position against future fluctuation. So that's basically the intuition behind it. Of course, when we get to the actual section 1, I'm going to say more details about this measure. But technically, this is the difference between the variance swap contract and the expected payment. And that's why this is called a risk premium measure, right? So the other advantage of using variance risk premium as our risk aversion measure is that we naturally have an uncertainty proxy, right? So Scott Baker would like to say, you know, this is not a direct measure of uncertainty. You would like to see that from text newspapers directly. But econometrically, that's the best we can get, you know, as the proxy for the uncertainty in the financial market. So with the risk aversion and uncertainty in hand, the other question we have to tackle is the co-movements, right? Typically, you see risk aversion and uncertainty co-move at the same time, right? Say during the financial crisis, you see people are both very risk averse, and you see the economic uncertainty goes up. So to exactly disentangle the two, we want to study events, for instance, high risk aversion events, such that the risk aversion increased a lot, but on the same day, uncertainty remains the same. So that's how we can call them, you know, this is a pure high risk aversion event day. And similarly, we identify low risk aversion event days as the following, right? So it's kind of symmetric, meaning when the risk aversion drops a lot, but uncertainty remains in a reasonable range, say between 10% to 10 percentile to 90 percentile. And similarly, we can get this high, pure high uncertainty period and a low uncertainty period. But of course, we focus on the high and low uncertainty risk aversion period for this paper. Now, and then you can imagine we have a list of high risk aversion days, a list of low risk aversion days. And the next point is, you know, corresponding to the challenges we have is the country origination. How do I know these increases and changes in the risk aversion in the US is caused by US events? And to put it in a short way, we integrate this high and low risk aversion event days with external news data from Raven Pack, where I can tell you, you know, what's the news of the day and where's the news coming from. So we keep the days when that's a US that's a news from the US. Okay, and eventually at the end of the day, we have identified 146 US risk aversion events and 77 US uncertainty events, and we'll look at the period from 2000 to 2017. Okay, there's no particular reason we stop at 2017, just because the project started at 2018. So I want to clarify, it's not data mining or anything like that. And just quickly, just to increase the confidence about this identification, we found that, interestingly, right, or actually not surprisingly, business and economic news induces changes in the uncertainty a lot, whereas politics and society news increase and change the risk aversion a lot, right? I think that's quite intuitive. Now, so we have this set of events, high risk aversion US events and the low risk aversion US events. The next task is event study. Because we identify these events, we want to see how much US risk aversion respond to this event as our baseline. So given the set of the events we have, right, these 146 risk aversion events, we found that on average, on a high risk aversion event days, US risk aversion significantly increased by 59%. And on the low risk aversion event days, US risk aversion significantly decreased by 62.6%. Okay, so rather symmetric. So that's the one takeaway from that. And on the same event days of US high-risk version versus low-risk version, we found that this non-US risk version significantly increased by 36.5% versus decreased by 27% on the low-risk version days. And in this paper, given the data limitation, we are only looking at Switzerland, Germany, France, Japan, Netherlands, and UK in this sample as our non-US sample. Okay, and of course, this number can mean high or low. It doesn't mean what does it mean, right? Is it too big? Is it too small? So we constructed a measure called pass-through, which is the ratio of the foreign responses to the domestic responses of the two groups. Okay, so we found in the high-risk aversion group, the pass-through is around 61% and above. And for the low-risk aversion group, the pass-through is around 43%, and these two numbers are significantly different. So that's our main empirical finding. We found that this transmission, there's an asymmetric U.S. risk aversion propagation from U.S. to these 6 developed economies in the world. Okay, all right. So with that in mind, the next task is to identify, why it's the case, why there's this asymmetric propagations from US to the rest of the world, or to the 6 countries we look at in the paper. And while financial market and news data can allow us to examine the US, the US risk aversion propagation in a real context, it is not ideal to examine the underlying mechanisms because the market is quite complex, and at maximum, right, we can say variance risk premium is an empirical proxy. It is not exactly risk aversion. So to examine the mechanisms in an experiment setting, one clear advantage is that in the experimental setting, you can exactly identify and calculate this person's risk aversion. Right, there's a very established literature in terms of experiments to how to lay out some questions to identify the risk aversion of your participants. So the key experimental setting is we have and designed this risk aversion treatment shocks and following some of the existing literatures, and we shock our participants through this priming process, right? Meaning I have this shock and I want to present that to you as the participant sitting in front of your computer, you saw this shock, right? Meaning it's an increase in price or decrease in price. And then after I shock you, right, I measure your risk aversion before the shock and after the shock. So if I observe, right, then I can observe whether in a high risk aversion group, your risk aversion changed a lot versus in a low risk aversion group, how much of your risk aversion changed, and then compare the two differences, right? That's the intuition behind these experiments. So we conducted 2 experiments. Study 1 is US participants. They are shocked by US shocks. Study 2 is the non-US participants, and they're shocked by US shocks as well, right? So you can see this experiment strongly mimics what happened in the empirical section, where you are seeing the same shock, but US and non-US participants may observe completely different, may have different behaviors, and why. So imagine, right, you're in Vietnam, so you are seeing a US shock, versus I am in the US, I'm seeing a US shock. So what's the main difference between the nature of the shocks? For me, US shock is the domestic shock. But for you, right, US shock is a foreign shock. So that's why comparing the results between study 1 and study 2, I'm able to kind of claim that the differences between the results in 1 and 2 should attribute to the foreign nature of the shock. Right? Okay, So that's kind of the general layout. And let me show you a beautiful diagram that I think it's quite clear. Just looking at just to summarize what we do. First, right, we have the U.S. shock to U.S. participants, and then measure their risk aversion. So that's our study 1. It's a local effect. Study 2 is the U.S. shock, but I measure non-U.S. participants' risk aversion changes, right? And so that's study 2. We found, as we established in the empirical section, we found that when the non-U.S. participants are shocked with U.S. bad shocks or best shocks, their risk aversion increased significantly, much strongly. Whereas if you are shocked with the U.S. good news or a low risk aversion shock, your risk aversion didn't respond as much. So that means, right, our study 2 can replicate this asymmetric U.S. risk aversion propagation that we observed in the previous section. Now, in terms of the mechanisms, why is that the case? Right? Oh, again, so that was the whole purpose of having experiments. We want to have this controlled environment so we can identify the mechanisms. We found, right, so you can already have one hypothesis, which we call a fundamental spillover channel. That means, right, the foreign nature, of the shocks may trigger more local pessimistic bias in the U.S. best group. So that means, why? Because non-U.S. investors, they update their beliefs about their country fundamentals after seeing a U.S. good or bad shock. And maybe in this process of perceiving a good and bad shocks, it may trigger different beliefs. And maybe, right, this hypothesis means the foreign nature of the shock can trigger more local pessimistic biases, especially when you see this U.S. bad shocks. And that's one hypothesis, and we don't find strong evidence about it. Now, the second hypothesis is more of a direct channel, right? So we're asking, the U.S. shocks could also directly affect the risk aversion of non-U.S. investors through affecting their emotional states. And we're not the first to examine the relationship between emotion and risk aversion. There has been several papers that shows that if you become more scared because of an accident or something, your investment behaviors today may reveal higher risk aversion, right? Papers like Ernst Furr's paper and Camilla Cohen's paper, etc. So a natural hypothesis for us and relevant for us is maybe the foreign nature of the shocks may trigger more negative emotions if you are seeing a U.S. high risk aversion shock, right? And we do find this channel being significantly important. And in terms of the magnitude, it can mediate around 20% of the asymmetric responses that we observe here. Okay. So this is the summary of our experiments and the second part of the paper. I hope this is clear. And in the next slide, I'm just going to quickly summarize what I just talked about, right? There's weak evidence of the fundamental spillover channel, but there's a very strong evidence of the non-fundamental emotion channel. And again, that means non-US participants, when primed with the US bad shock, shows asymmetrically lower positive emotion, higher emotion, negative emotions, and higher risk aversion. And we found that this emotion-related mechanism explained up to 20% of the propagation asymmetry, and the potential mechanisms could be, potentially because the foreign nature. Right? So we are arriving at this conclusion, meaning the foreign nature of the bad shock triggered more negative emotions, and that triggered higher risk aversion responses of non-US participants. Right. So why foreign nature of the negative shocks can trigger more emotion? So this can potentially relate to some of the studies that talks about familiarities, right? Because you are less familiar about this negative shock, and that's why you become more triggered in some sense, right? And I think that's quite relatable. For instance, if you are say you are sitting in Vietnam and you're looking at U.S. election and you have no idea what's going on, so it sounds so bad, right? Like my family, they're still back in China, but as they hear about the U.S. COVID cases going up in March and April, going crazy, they have no idea what's going on in the U.S. and they completely panicked for me, and I think that's quite relatable. Okay, so that kind of summarizes the paper in a couple of slides, and I'm going to skip this contribution part, right? Because I think it will become natural as we go through the paper, and you will see the contribution. But I will summarize them again after at the end of the talk, so that you feel like this is reasonable and you can relate to it. Okay. Now the presentation. The presentation has 3 components, and because I have introduced some details already in the previewing of the results, some of the details in the next several slides will go through quite fast. But feel free to ask questions or stop me if I'm going a little bit too fast. Okay. Okay. So a big picture and challenges of identifying high frequency risk aversion around the world. There are 4 different challenges that we have talked about. One of them, again, so why this is challenging to identify this risk aversion propagation question we're after. Measurement of risk aversion, right, hard. There should be confounding factors. Besides risk aversion, uncertainty is another very important risk premium component, right? How to identify the origination of the shock has to be coming from the US. And the other one is the narratives, right? We eventually want to make sense of the events we select. So and then we designed this methodology, as I've briefly talked about early, and now we're going to go into the details of the study, of the design of the empirical evidence. So we have this 2 data set which have different features, and that helped me overcome these 4 challenges, right? Just to summarize, the financial market data helps us with the measurement, of course, and help us identify the confounding factors. And this news data can help us identify the US origination of the shock and provide potential narratives. Okay, so this is a summary. Motivation of the measure. So let's go through the first and one by one in the next few slides. Risk aversion measure, it's difficult to measure, right? And I have a whole paper on it. Feel free to read that paper and use our measure. Now, but one very prominent and commonly agreed class explores the curvature of the utility function of the representative agent. So you are familiar with Campbell-Cochran, right? And Jessica Walker's paper, where they use consumption growth to as a proxy of my time-varying risk aversion, right? It's the idea of habit formation, meaning if my consumption is close to my habit formation or my habit level, or even below my habit level, I panicked because suddenly I cannot sustain my consumption level, my quality in some sense, my life quality. And if my consumption shoot up a lot, right? And then likely that means I'm less budget constrained and I'm happier, right? I'm less risk averse. The problem with that approach is that there's no way we can get daily consumption data, not just in the US, but also in the rest of the world. So that is not likely a go-to. And then here comes my own paper, right? As I show you on the first slide. That measure can work, and it's filtered from asset prices, and we do have a daily measure of risk aversion, but it requires a whole estimation. You know, on my website, I did that for you, right? In terms of the US risk aversion index, but we haven't explored whether this mechanism and model applies to other country. Applying to other country, there are some complications, right? For instance, you have to control for US shocks in other countries, thinking about the US as the global economy in the world, right? The dominant economy. So this is another dead end. And then we look at the literature, and we try to find a measure that can be obtained at the country level, daily level, and as well as, you know, in terms of construction, should be relatively easy and people can easily replicate. Then we go to this risk premium, variance risk premium story, right? And the intuition is quite simple. It essentially captures, you know, this. If risk aversion investors should dislike very large swings in volatility, especially in the bad times. That's why they're happy to pay more to have a hedging position against the future volatility fluctuations. Okay, and in the bad time, when if you are more risk averse, you should be able to. You want to pay more, right, to have this hedging position. Versus during good times, you maybe say, I don't need this hedge or insurance, and you don't want to pay this excess price, and that's why typically we see this variance risk premium being positive, right? That's a well-known fact. So we explored this idea, and as I mentioned earlier, one advantage is I can have uncertainty measure from the system. So I can estimate the uncertainty, and I can also have the risk aversion at the same time, which helped with the identification of having a pure risk aversion days versus co-moving risk aversion and uncertainty days, which we don't care in this paper. Let me see, and I have laid out several advantages of that. I think I've mentioned all of that, right? Variance risk premium is observable, and in some papers, we have established the close relationship between variance risk premium and equity risk premium, right? And of course, the theoretical link and estimations where we showed that investor relative risk aversion should be highly correlated with variance risk premium, easy to construct. And we can obtain that at major economies in the world at daily frequencies as well. The disadvantage of that, which I didn't put on the slide, is obviously this is a proxy, right? And that really put us in the position of thinking hard to have a second section of the paper, which is to use experiments to exactly measure risk aversion. Okay, but let's think about the empirical exercise first. Formal construction is a difference between the implied. I'm going to skip this slide because I think for those who know this literature, this is a waste of time, and for those who don't know this literature, it's painful to go through this together with me. But the whole intuition is I'm decomposing the volatility index and into two components: uncertainty and risk aversion. Okay. Now, suppose we have this time-varying risk aversion. I'm also interested in the shocks, meaning how today's risk aversion changed compared to expected level, right? So that's what I'm interested in, meaning what's the abnormal risk aversion compared to the expectations. So how to do that? I simply project and regress the risk aversion onto some right-hand side variables that include, for instance, a moving average, as well as a collection of last available monthly or quarterly country fundamental variables. And this epsilon here is of interest, and that is my risk aversion shock that I'm going to talk about in the rest of the presentation. Okay. Uncertainty shock can be easily obtained as well by running the similar regressions. So Now, looking at this country daily implied volatility indices, and that really explained the sample limitation here, say why we look at the 6 countries we look at, and the time series as well. So we look at the 6 countries, right? You see most of them, only 2 countries are from the Euro area, right? This using the same Euro currency. We have Switzerland using a different currency, Japan, Netherlands, and UK, right? Of course, the US, it will be our benchmark. And I look at the sample from 2000 to 2017, and basically the data is quite standard. And here's the time variation of risk aversion in black, and this risk aversion shock in gray. There are several observations I want to mention. One, you observe risk aversion and uncertainty, they're both countercyclical. So that justified my concern early on, which is, you have these confounding factors which move together in bad times. And that's exactly the reason we want to disentangle the two. And the other observation is that if we cleanse out the expected component, say we have this gray time series, that's my shock, right? So this is the risk aversion shock, this is the uncertainty shock. The correlation between the 2 gray lines between very small, around 0.1. So that is also expected because we teased out this business component from the levels. I heard someone was trying to ask questions. Am I hearing this right? No? Okay, cool. Maybe someone just misclicked the button. Okay, and then the other observation I wanted to emphasize is we have to deal with the fact that not all spikes corresponds to a unique event, right? Say you see a bunch of fluctuations here. This is likely one event, right? This is a business cycle, financial crisis event after Lehman Brothers went bankruptcy, and the other example is like this part, right? This looks like one event as well, just being a little bit persistent. So if I just draw the clear cut of say 90%, it doesn't help because you are only going to pick up the global financial crisis. So our strategy is to create, say, my high risk aversion bucket has risk aversion shock being in the 90th percentile, and then the US in the normal, right? I've talked about that. And then I'm trying to identify the other challenge, which is the US origination. How can I make sure the shocks there is coming from the US? So we integrate the news data into our spikes and identify, try to identify the US originations of these shocks and keep these shocks, right? So eventually we identified, right, so there are 4 steps, but eventually I've explained the integrations behind the 4 steps, right? So these 4 steps should help me resolve the 4 concerns I had early on. Now, what do we see? We see 146 risk aversion events. 86 are identified as high risk aversion, 60 are identified as low risk aversion, 77 uncertainty events. And the other thing I really like is it kind of equally spread it out across the time. It's not like, we have every events from the global financial crisis around 08 and 09, right? That's exactly the thing I want to avoid. And the reason we are able to achieve that is because of, I have regressed this measure onto some persistent variables to tease out the economic business cycles, right? And in terms of across different news categories, I think this can help me increase the confidence of this news identification, right? This event identification. For instance, we identified, right? There are 4 groups. So we identified that business and economy news likely have appear more often in uncertainty news. whereas politics and society events likely appear in risk aversion news, right? These dark gray bars here. So is that intuitive? And then I tried to go to some literatures and found some supportive evidence. You know, I put Baker's paper there. I think you heard exactly this paper a couple weeks ago. And one of the main point was macro policy announcement significantly you know, increased asset prices and caused the asset prices jumps. And in other words, kind of lower the uncertainty from the market. So that's consistent. And in terms of politics and society news, we found that you know, high risk aversion news, you see war conflict, you see accident, you see shootings. You know, in the US, there's a lot of shootings going on, which is not good. And it shows up in the financial, in asset prices, right? People are scared, crimes. Low risk aversion, we typically see elections. It's very interesting, right? Regardless of the parties, because in the US, right, there's always two parties fighting. You see this kind of, these events always go into this low risk aversion bucket. Event study. So now we have, hopefully I've convinced you about my event selection. First, I need to identify the changes, right? The changes of the risk aversion in the US on the high risk aversion event days versus the low risk aversion event days. And that's where the 59% and negative 63% came from, right? On the event days, this is the percentage increase or decrease of US risk aversion compared to a expectation level. Quite symmetric, right? And this is the plot. And I'm not going to repeat myself, but basically you also observe some interesting features. For instance, it's quite short-lived. It kind of goes back after a week. Right? Think about 5 days as a 1 week of trading week. Okay. Now, what's interesting is the foreign responses. So this table shows you, if you look at just the 00, that means the event days, average non-US risk aversion changes corresponding to the US risk aversion event days. So we found this number being a little bit higher during the high risk aversion event, US high risk aversion event days, and lower, right, in terms of magnitude for the low risk aversion event days of US. And again, as I mentioned early on, is it large or small? We don't know, so we need to test it. So we run this test of, so this is the pass-through, meaning the ratio of this number and the same number with the US risk aversion changes. We found these two pass-throughs are significantly different from each other. And we run several robustnesses as well that shows the results are quite robust. So again, the main takeaway from the empirical section so far is that there's asymmetric US risk aversion propagation. Okay, very good. And that's the plot, and that's some empirical kind of checks with uncertainty on uncertainty shocks. We found the uncertainty shock pass-through is not asymmetric, and we also did some cross responses checks, and there's no as expected, right? Because we identified our shocks quite orthogonally. There's significantly weaker responses as expected. Now here I'm going to use the rest of the time to talk about the experiments. I think you will find it quite fun because I did enjoy this process. Again, why do we need this section? It's because people have been arguing, and I was one of them, can we really trust the variance risk premium as a proxy for international, for country risk aversion? Because it may also capture, say, ambiguity uncertainty or night and uncertainty, etc., right? But the advantage of having experiment is you can exactly measure risk aversion from the piece of paper. So that's one. And two, we can identify the mechanisms in a much more controlled fashion. And this is the routine of the survey we're conducting. We have icebreaker questions. We have baseline investment tasks where we get their baseline risk aversion, meaning before the shock, and then we shock them, and we measure the risk aversion after the shock, right? And then at the end of the day, we collect some demographic information like where are you from, what's your occupation, etc. Pretty standard. And our international participants turned out to be around, mostly they're males somehow, and they're age 30 to 40, so our age, meaning working age. Annual income is this, so kind of middle class, right? And most of them have never been to US. So that means it's good because we don't want people to have very deep knowledge about US, so the shock is not pure. And on average, they do have some investment in the US, which makes sense because the US has the biggest market in the world, right? You have to invest in the US at some point in your life. And they have to speak know English, right? They have to know some basic financial knowledge, meaning if I ask you what's the volatility, which asset has a higher volatility, stock or bond, you need to enter stock to enter the next stage of the survey. And this is the country distribution. You see, it kind of highly mimics what we have in the previous empirical analyses. So that's good. Now, what is the shock? I mean, so far I've been talking about shock. I'm not talking about electric shock, right? I'm talking about a very mature experimental setting where you show participants some pictures and let them stare at the pictures for a long time, so they live in the picture. So for instance, we're following Cohen et al.'s paper published in AR about their risk aversion shock. So this is a high risk aversion shock, or it's a bust shock, because it tells the participants, all right, the price just keeps decreasing, right? And then they have also a boom shock. So so that's called a low risk aversion shock. In their paper, they don't have a control group, but we do need to have control group because we study asymmetries. So that comes to another advantage of using and building on their risk aversion shock is that we can design our treatment group in a relatively similar fashion, right? This means price keeps decreasing, but the volatility remains the same. And we can design the counterpart where price is not decreasing or increasing, but the volatility is increasing, right? So these 3 and 4 naturally becomes our control group, and 1 and 2 becomes our treatment group of interest. Okay. In terms of the priming method, we basically ask them to look through to reach through this plot for 5 minutes and try to write scenarios of what do you see, what do you think, to guide them into the scenarios, right? But there's no right or wrong answer, and I don't care what they write, right? I just care that you spend the 5 minutes thinking about these experiences, right? How to measure risk aversion? We built on Genesi and Potter's paper and also being used by this Cohen's paper, meaning I give you $1,000, right? And I tell you exactly the outcome of this investment, risky investment. And for the rest of the share, you put it in a risk-free asset with no returns. So it's like cash versus risky asset. And I tell you exactly the payoff probability. So there should be no ambiguous. There should be no ambiguity right there. And I give them some incentives so that they actually want to take the time to answer the question. And again, if you select a higher risky asset, that means you have a lower risk aversion, right? So that's a little bit like the opposite direction. Okay, very good. The control variable, randomness, I'm going to skip that. But basically, we do the normal things. And here's the first result, right? First result is we want to replicate the main result we found in the empirical section, which is when you are receiving a bad and bust US shocks, how does your risky asset change? We see US participants dropped their risky asset, meaning their risk aversion increased. And for the low risk aversion treatment, when you are seeing a US boom shock, you see your risky investment increased, right? That's why I have this direction here. In terms of the control groups of the US participants, we found nothing, right? That's exactly what we wanted to see, meaning this shock is working, that's good. But in terms of the non-US risky investments, you see when non-US participants are shown with a US bust shock or high risk aversion shock, their risky investment dropped significantly and the size is much larger than the high risk aversion group, right? Your question, do you check whether all participants are risk averse? Minh, can you elaborate your question?
Okay, can you hear me?
Yes, I can hear you.
So I don't know, here it seems like you assume everyone are risk adverse, but in reality we don't know, right? We need to check that, right?
Yes, and it's very easy to check, right? Because say I ask you to invest $1,000. If you are completely just crazy and risk taking, you are going to choose 1,000 to invest in a completely risky asset, right? We don't see that scenarios often. Most people choose say 200 invest in a risky asset, 500 invest in a risky asset. So we don't have these boundary conditions, and that means these users are relatively reasonable, kind of in showing that they're risk averse, right? Because only when you are risk averse, you are going to choose a risky investment that's less than $1,000.
So it means nobody risk loving?
No, that means everyone in the sample started being there are risk averse investors to start with, right? Because if you're completely risk taking, and if I give you $1,000, you will choose $1,000 to be invested in a risky asset.
Okay, right? Thank you. Yeah, thank you.
Sorry, I have
so again,
questions.
Yeah, of course.
It's quite counterintuitive because from the prospect theory, we know that most of people are risk taking. Is there any contradiction with your experiment? Because you know, from the prospect theory, people are risk loving, risk averse. Yeah.
No, but perspective theory is just talking about some groups of people, right? I mean, majority in the economic theory, we think about people being risk averse. But in certain scenarios, you do observe, I know you're talking about risk taking, the gambling behaviors. But usually in these experiments, we observe people being risk averse. And we particularly don't, we want to exclude people who are gambling, because that is not the theory we're testing, right? So from that perspective, you can identify people, whether are being perspective theory people or they're being standard risk averse people from their answers. So yeah, and from the sample we have, people are relatively behaving pretty intuitively risk averse, right? You can observe if they're shocked with a very bad shock, they decrease their risky investment, and if they're shown with a good shock, they increase their risky investment, right? So I don't think these two, these are different theories, competing theories itself, and but that's not our interest of identifying one theory versus the other. We're trying to follow the traditional the papers that have been running these experiments for many years, and we're just following their mechanism. Okay?
And there's another possibility. For example, what they answers in the surveys are different from what they did in the market. So how can you deal with that situation? That doesn't mean that they are lying.
What do you mean by the answer in the survey? Because I'm not asking how they invest in. in real life, right? I'm not interested in that. I'm interested in, say, you come in, show me how much you invest, say 400, and I show you some very, show you one of the 4 plots, and you spend the time living in this scenario, right? That's the priming, what we're talking about in psychology. It's the priming process, meaning you live in this world for a long time, 5 minutes, and then you re-answer the questions about your investment choices, and that's the shock, right? That's so that procedure has been quite established, and we're following this paper. Yeah.
Okay. Thank you.
Yeah, no problem. I think I need to hurry up a little bit, but.
Okay. But actually, I just have like very short question. Like
sure.
In the previous experiments, like do you define the people in which status they are? Because like if I am in the last, let's say in the lab pictures you show the decline prices, I feel like okay, I'm in the last domains. But actually, if the price is going up for many days, that I'm okay. My psychologist effect that I'm in the gain domains, that my behavior might be differences. Then I'm not sure if you captures, like for example, for a lot you might in the deep literature regarding to the hot hand fallacy. So many down rate decline price, and I'm not sure how many people they expected to invest in the lab chart, because they might think that okay, so many decline price, then I would take this risk to going up.
Yeah, and I see what you're saying. So you are thinking, even though people are seeing this trend, they think it's going to go up anyways at some point of life. So that's why I want to invest in a deep, right? But we do observe some people are thinking this way, and I will show you why.
Okay.
I'll show you why. We do have some suggestions of that, but not a lot. I think it's because, one, I didn't specify the unit of the days. Right? If you say this is 5 months already, then I think it's going to go up. Or like if this is a 5 years, I think people will think,
that's
business cycle is like 8 years, right? So if your 5 years decline, you have to go up. But I'm being very vague here, right? This can be days, this can be minutes, and exactly to avoid the concern you have, right?
Okay.
But I do have some evidence to be quite consistent with what you say, but I have to get the result there, and then I can show you that, right? It's after a couple of slides. Okay, so just to formalize what we found, right? We found that study 1, there's in the high risk aversion treatment group, how much do investor changes, right? Risky investment changes goes down. That's very intuitive. And for the good environment, right, you see risky investment goes up. And can I reject the magnitude between these two are different? No, I cannot. The p-value is very, very high. Now for study 2, I am able to reject the differences, right? These two numbers are being very different from each other with p-value of 0.03. So this table shows you kind of replicate this UX asymmetric propagation. Now in the remaining 2 minutes, I'm going to, so you have seen this plot, right? This is our rationales between, what might be driving the asymmetric results we're picking up. One of them is that the foreign nature of the shocks may trigger more local pessimistic bias. And the other one is about this direct influences from emotions. We do not find strong evidence of the first class because it's quite symmetric. But now coming back to Towen's question, right? We do observe if you are in the high risk aversion treatment, meaning you are seeing this bust shock, you may believe that the local prices are going to go up. So that shows you a little bit of, you are already in deep and you want to come up, right? So I think I think this is capturing some of that, but not significant. I want to emphasize it's not significant. Right, the t is around 1.4 or something, right? But the direction, it has some mean reverting thinker in our sample. Now, what's more relevant is about the general emotion increased, or emotion in general changed only during the high US risk aversion treatment. And because of this asymmetric changes in the emotion, that made the emotion a significant moderator and a mediator for this treatment, meaning column 12 is the original regression we saw a couple slides early without any mediator. The asymmetry was around 0.5, meaning the difference between these two divided by 58. If I add this mediator, this asymmetry becomes 0.36, and the difference is it drops by 20%. So that means if I add this mediator, I'm able to being emotion, I'm able to successfully mediate this asymmetry by around 20%. So that's economically sizable, right? It's not just 1 or 2%. And we further decompose emotion into positive emotion, negative emotion. The positive emotion channel explains 12% and the other explains 8%, right? Okay. And just to summarize quickly what we see that the US shocks could directly affect the non-US participants' risk aversion through affecting their emotional states. And the foreign nature of the negative shocks can change the emotion more. Why is that? We think it has something to do with the foreign nature of the negative shock can trigger, can make people feel more, because it's a foreign nature. So it's an unfamiliar negative shock, which can make people fear more or having a more sensitive emotions, right? I'm running a little bit out of time, but we are arriving at the conclusion anyways. So I'm going to just say a couple words, what is the takeaway I want you to have. We use financial and news data to show that US risk aversion has an asymmetrical risk propagation to the 6 non-US countries we look at. And the high risk aversion propagation is around 60%, but for the low risk aversion propagation, it's around 43%, right? And in experiments, we are able to replicate this excessive US high risk aversion propagation. And we tested across some mechanisms, and we found this, the foreign nature of negative shocks may change the emotions more than that of the positive shocks, and therefore driving this asymmetric risk aversion. And of course, that's not the only solution. I think there may be other fundamental reasons that we can potentially test and capture, right? I want to close this presentation with this book, right? Animal Spirits: How Human Psychology Drives the Economy and Why It Matters for the Global Capitalism. Schiller had this idea, and then they wrote it in the paper, with this such a contagion in the world, blah, 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 or there could be worldwide fluctuations in animal spirits. In our paper, we're capturing this co-moving animal spirits through this co-moving risk aversion, and it turns out emotion is a big impact, right? All right. Thank you very much. I think that concludes my presentation, and happy to stick around if you have any questions. And thank you so much for inviting me as well.
Yeah, thanks a lot. So actually, we still have like some minutes for Q&A section. So anyone have questions, please go ahead. Actually, please waiting for them to think. But actually, I just want to ask whether in your survey of experiments, do you have any risk reference questions? Because at the end, you also claim that people, they are unfamiliar with, let's say like unknown shock, right? Unknown thing happens. So I'm just curious whether you have like any risk reference questions or ambiguity selection questions for people to validate these findings to make a result.
So what kind of risk preference question you think we can put there, right? Usually, I think in the normal practice, you don't want to ask investors, or you don't want to ask participants the variable you are using to measure on the left-hand side. Ask about your outcome variable, but you can measure your outcome variables. Right? Say, I can ask, what's your risk preferences, 5 or 10?
No. Normally, I usually give them like the package of assets, for example, a bond and stock, and ask them to assign bond, how many percent of bond want to put in your package on stock. Then in that sense, I can capture their risk preference to use like bond or stock. Then,
you mean in real life? You mean kind of you in a real life, you ask them how, let's say 40% in your stock, and then
they can adjust. I mean, I put the middle range in the middle and let the participant they can change the range bond and stock portfolio. That's my strategy, but actually maybe it's not related to your study. But
that's exactly what we do, right? That's exactly what we have. We have this bar of from 0 to 1,000, and I let them slide, right? That's exactly how I measure the risk aversion, right? Maybe I went through too quickly, but so there's the choices and there's the cash choices, right? I'm trying to let them choose, say, Ton, you choose $800 to put in this risky asset, and I choose 200 in this risky asset, and you just slide the bars in the middle. Yeah, I think that's
but before you ask the participant to choose, or after, before or after?
Both, right?
Both.
So
okay.
I tested the risk aversion before the shock, and then after the shock.
Okay,
right?
That's what I mean. Yeah, that's true. And another thing I think you can put in, you can consider is like real geography, because like you also have because the literature also indicate that, for example, how distant from the US to Germany, let's say like 10 million kilometers, then you also see that like the longer geography that the people can perceive more less risk, less unknown thing happen. For example, let's say I'm in Vietnam with 12-hour differences with the US. But if I were in Germany, so it's just like 6 hours, let's say the distance is like shorter, then I think that like I'm more confident to understand the US rather than I'm in Vietnam. So I think you can.
Yeah, I think that's a very good question, and eventually can be tested because, so I think that relates to, meaning the farther you have, to the source of the shock, the less you think it's a relevant foreign shock, and that's why you react. I think that's a very interesting nonlinear test we can have, but we didn't have it. Yeah, because remember we only explained, we explained 20% of the asymmetries just using emotions, and can be other things, right? Can be other things. I think one of that is what you mentioned, and maybe the other one perspective is economic distances, right? Or cultural distances between the two countries. Think about Japan versus the US must be very different from UK versus US, right? US was from UK, so so that's
sorry.
These are interesting questions. Of course.
Sorry, I have an opposite idea. I have an opposite idea because now we have internet, so news spreads widely and fast, very fast, and usually large trader they use computer to trade. Only small trader, non-professional trader use them. I mean, your experiments only focus on non-professional traders, very small trader. But large trader, big investor, they control the market. I mean, in terms of volumes, something like that. So how is the correlation means? I mean, we cannot say we did some surveys for a small group of non-professional investors per the properties of the lax trader. I think it's not so convincing for me.
I see.
Is that correct?
Yeah, well, I'm not trying to infer everyone. Like, there's no way I can send service to all the professional investors in the world, right? It's been extremely hard to, that's an ongoing question in risk aversion. Like, how do we think about the measurement as well as explaining what happens, right? So I'm not saying kind of this is the only mechanism out there, right? Obviously, we only explain 20%, so can be other reasons. But think about non-professionals and professionals; they all have emotions, and emotions It's not like if you're a professional, you don't respond to news with this emotion. So these people are human beings, right? In some sense, even though many of the tradings are executed by the robots, but a sizable amount of people they are doing kind of tradings. So maybe the other 80% we couldn't explain is because of some other channels. But also putting this in experiments is very, very hard, because you can only ask them like 20 questions and they're like they don't have any patience anymore and they want to leave. So the fastest thing we can test maybe is is the idea of showing just test something that every human beings have. So that's kind of we had when defining this experiments, right? But I think this is a very good question. I do have this doubt myself. Can we think about this variance risk premium having the same agent, being the same agent as as what we have in experiments, right? So that's a good question. Yeah. I see there's a. Sorry, go ahead.
Yes, and I have another question, because in your paper you use the difference between variance graph and expected variance to measure risk aversions. But I also know that there's a recovery theorem of Ross. He could estimate the risk aversion parameters from option price. But this is a more direct approach than yours.
Oh, sorry, whose paper?
Yeah, yes, I put it in the chat box.
Okay, let's see. Yeah. Caroline, or let's.
Okay, can you see the chat?
Steve Ross, is that the paper?
That's the recovery theorem.
Yeah.
Steve Ross. Yes.
Okay. And what? So they have a risk aversion measure. Is that right?
Yes. So because your purposes are different, because you measure risk aversion for different countries. But I'm wondering if the method of Ross can be used.
Usually, I mean, that's one of the reasons we want to use a very simple measure, right? Because well, it's a very heavy estimation they have in this paper. Like, am I going to do it for every other countries, and can I use the same framework to do it, right? I don't think that's attractive. I think replicability of the study is very important, right? So that's why I kind of want to use a state of the art to be the proxy for risk aversion in the paper, right? But I will take this paper in more detail. Look at this paper. It seems like it's a very busy paper, right? They have probability of a disaster, and then they also have risk aversion. Interesting. I haven't read this paper, so I will definitely take a look. Very good suggestion. Thank you.
Thank you. I just wondering if this method can be used for other countries. Yeah, thank you so much.
Yeah, but you have to think about many dimensions. One, it will have the same problem as I have here, which is the option market, right? Yeah. It's professional asset managers, right? So it's still not everyday people. So that's one question I have. And two, this estimation may require very heavy estimation for every single country. Then you run into what, like measurement errors and estimation errors, and referees will be not happy with you anyways, right? So that's another challenge. And the other one is they only test in the US. The paper doesn't say much about using the same framework in other countries, right? Because whenever you think about other countries' estimation, we have to think about factor structure. Like everything needs to have a factor structure now. Like cash flow has to have a US component, right? Because relative to the US, everyone else is a small country in terms of the market size, right? So you have to take into account of that. So I'm not sure how to implement that, but I think that will be a useful citation, just to address other measures out there. I'll take a look. Thank you. Thank you. I think the audience has one more question.
Yeah, one more question in the chat box, please.
So I think he or she is asking, are risk, uncertainty, and shock interchangeable? No, they are not, right? Well, typically in finance, we think about the risk as the co-movement of, say, aggregate shock, aggregate risk, or aggregate risk factors, right? But you can roughly say, risk is about risk premium. So risk premium has two components, right? There's a risk aversion component, and there's a amount of risk component. So that's uncertainty. So think about risk as a risk premium, and uncertainty as the quantity of risk, right? So we have, say, like Scott Baker was saying, I think a couple of weeks ago, the amount of the numbers of mentionings of uncertainty in text newspapers, right? So that can measure the quantity of risk or amount of risk, or in other words, uncertainty. Shock is, to me, right? Shock means, or actually in the mathematical format, right? For sure, right? Shocks means the abnormal changes from today or yesterday, or from today to some expected value in the past. So you can think about shocks to risk aversion, that is the changes in the risk aversion, or the unexpected part of risk aversion. And shocks to uncertainty being unexpected movement in uncertainty, right? So these are three different concepts. But risk aversion and risk appetite can be used interchangeably because they are completely opposite concepts. I hope this answers your question.
Yes, thank you very much.
Answer.
Because just I am reading some paper about risk and shock and uncertainty, and I realized that something similar with what you are talking. However, you know that I'm reading in credit, risk in credit, and there are some paper use risk and shock interchangeable. So I'm going to reading something more and have a distinguish about this terminology. And thanks for your information. Yes.
Yeah, but again, I just want to add, risk in finance, as we know, is not a shock, right? Something is risky because it co-moves with something.
Exactly.
Right. So I want to make sure this point is crossed carefully, right? So risk, usually we think about risk, it's risk premium. If I demand a higher risk premium from some asset, that means this asset has a high risk, right?
Yes.
So I think I've said what I wanted to say.
Yes, I love your information about risk premium, and maybe I will read more. I will read more about this. Yes, thank you.
Great, thank you. I think Minh has a question. Are shocks in your study one time or evolving over time? So I think he's maybe after the idea whether shocks are permanent shock or transitory shock.
Yeah, that's true.
So we don't come with a prior, right? We have this methodology identifying some of the shocks, and shocks by design, right? Actually, yeah. So do I have the slides? Because I do maybe want to show the. No, I don't have it. So eventually, we do observe, right? Remember, I have this high risk aversion shock and high uncertainty shock, which I don't focus on in the presentation. And the high risk aversion shock is a very transitory. It kind of falls back to normal after 5 days. But high uncertainty shock, it can last for 22 or more days. So from that perspective, we can conclude out of sample, right? And say uncertainty shock likely it's a more permanent shock, at least for some period of time. Whereas risk aversion shock, from our analysis, we found it's more like, as you mentioned, it's a one-time shock and being more transitory. And I'm not sure if I can put the COVID-19 in the same comparison, because if you don't mind, I want to share with you this slide again in the beginning of the talk. Remember this, right? So in the US financial market, COVID event corresponds to only 2 shocks. So the initial declaration in March 2020 and the second wave in January 2021. But that's what happened in the US. And so you don't see COVID shock being extremely persistent and doesn't draw back. It draws back. The market wasn't afraid of COVID, at least from risk aversion perspective, right? A couple months after March 2020, it falls back. It falls back. And if you are familiar with VIX, right, you should be able to know VIX only spiked in 2020 March and falls back immediately afterwards. So in some sense, when you mentioned, or Minh was saying, COVID shock can be a permanent or persistent shock and evolving over time. Yes, it is an ongoing crisis, even for Vietnam and for India and for US as well. It's an ongoing crisis, but market perception of the crisis does change over time. It seems like there's only it is a shock when it is the first time people seeing it, right? As just going back to Hai's question, it is a shock when it is different from yesterday. But if I live in this ongoing crisis, it is not a shock, right? Say this is June, July, all the way to the US election. There are 6 months. People are relatively complacent and okay, and they just live with the new norm. Especially, at least that's what reviewed from the asset prices in the US.
Sorry. Okay.
Does that answer your question, Minh? I'm not sure if I answered
Can
this.
You hear me? Can you hear me?
I can hear you.
Okay, so how can you determine there are only 2 shocks related to COVID-19 in US? You based on the news or what?
No, that's from my other paper. Right. So that's from the other paper of mine, where let me share my screen again, because I was trying to come back to this discussion so that I can see everyone, but yeah. So basically, this is from my other paper, and in that paper, it's a very heavy estimation, meaning the idea is the following, right? If you believe risk aversion is priced in asset prices, then some combinations of asset prices should help us reveal risk aversion. So we're trying to find the optimal delegation, right, or the relative weight of each asset prices in determining the US risk aversion, such that this risk aversion candidate can maximally explain a lot of asset prices dynamics in the US. For instance, risk neutral variances, physical variances, skewness, risk premium of corporate bond and equity market. So that was being done and in our estimation. So once we have this optimal weight, and we observe, right? We observe daily prices on a, every day, or even you can go every minute. We can impute, right? We can impute this latent risk aversion using the weights that we estimated from the model, right? So that's how we identify it. It's nothing from newspaper. It is from a habit formation framework, meaning we're trying to filter a time-varying risk aversion that is consistent with a habit formation model, as well as the realization of asset prices on a daily basis. So that's the idea behind this paper. I was trying to avoid saying this because I wanted to focus on the new work, but it came back and I want to explain it again, right?
Okay, thank you, thank you.
Yeah, but just come back to this point. So it's so natural these days for people to think, okay, let's filter something from this Twitter, let's filter something from, from newspapers, right? I think the Nick Bloom and Scott Baker empire is quite large right now, right? I've talked to Nick Bloom about filtering risk aversion from newspapers. It's so hard because in the newspaper, right, you can count the numbers of uncertainty, whatever, and that's exactly what we wanted to do, is to capture the quantity of risk, right? How many times you mentioned, that's very easy to quantify, but how to measure, how to count the price of risk, which is risk aversion, that's impossible. And in the newspaper, the journalists have their risk aversion, right? And then they have journalists write about the aggregate investors' risk aversion. So there's double layers of a lot of things. It's extremely hard. And if you have any ideas, let me know. Right?
Nancy, but do you capture like the reversion effects? For example, like if you mentioned like risk aversion as like a risk premium, like you need to pay to endure for that kind of risk. But actually, if you overpay, then several days ago, following days after you overpay for that kind of risk, you tend to, let's say, you less paying. You think that like you overreact to that kind of risk, and you might less paying.
Yeah.
I'm not sure that in your paper you captures like that psychologist effect from the human being. For example, like you over panic.
We don't care, right? We don't care because in that paper, the estimation is done in the monthly frequency.
Mm-hmm.
So if you are thinking about human kind of natures of thinking, mean reversion or anything like that, it's likely high frequency. It's likely like every week I'm going to rebalance, and you're talking about millions of people trading on options or stock markets, right? So I think it's going to aggregate out. And that's why, going back to, I think, one of the questions early on, small investors versus, the whole option market, how to reconcile them. I think it's a very interesting question, right? But we're not the first to use experiments to test macro behaviors. Like Ernst's first paper in AR 2015, they have a similar setting, and they claim, so people are seeing this drop in prices, the risk aversion increased, and then people seeing price increasing, risk aversion drops, and they call it a countercyclical risk aversion. That's it. That's the AR paper. So we're just borrowing the same mechanism and adding our control groups, right? To because you can only study these behaviors by looking at a smaller, confined and controlled sample setting. Otherwise, in the real world, it's very complex, right?
Right.
So very interesting.
Yeah, thanks. So I think we are running time now, 1.5 hours. So before closing the seminar today, so I would like to invite Professor Nguyễn Trọng. He's like the editor-in-chief of Journal of Asian Business and Economic Study, and he wants to say the remarkable thankful message to Nancy. So please. Please unmute. Please unmute. Okay.
Okay. Thank you for your introduction, and good morning, Dr. Nancy from Vietnam. Actually, I have followed all times for your presentation and also for our discussion. Actually, I have know much about risk aversion in economics, but for the risk aversion application in finance, actually I don't know very well. But for the approaches from Dr. Nancy, we have known very well about two approaches. One from empirical study and the other one from experiment. So empirical studies in finance are very big field in Vietnam and also in our university, and also very much paper regarding to this topic. But regarding to the field of experiment in finance, very rare people in Vietnam to do so. So through the presentation from Dr. Nancy, we learned very much. And on behalf of Zabas, I would like to thank for your contribution to our talk, and hope to see you in person in Vietnam, especially in our university and especially in Zabas. We hope all participants already enjoyed the talk with Dr. Nancy and also enjoy the discussion with Dr. Nancy. And we do hope that participants will send your paper to Zabas in the future, both in Vietnamese and English version. And we also do hope that Dr. Nancy and your colleagues and all participants will join our international conference ABES in August 2021. Again, thank you very much, Dr. Nancy, and hope to see you in Vietnam and Ho Chi Minh City and US. Thank you very much.
Yeah, thanks.
Thank you. Thank you so much. I had a good time.
Yeah, thanks. Yeah, thank you very much.
Thank you very much. Thank you for your interesting talk. Thank you so much.
Thank you. Thank you.
Thanks.
We take the snapshot for the talk and to remember about the event, Tuan.
Yeah, I think anyone, if you still have cameras, please turn on your camera. So, I mean, we also hope to have like camera section, photo section. Actually, even online, we can have like photo section. So, yeah, please. If you still have here, please turn on your cameras, and we also have like photo section. So I think wait a bit, but some people don't have cameras. So okay, so that's enough. So thanks. So 1, 2, 3, say cheese. Okay, so thanks a lot. So if you have any question, just maybe follow on Nancy website. Yeah, thanks.
Bye.
Thank you.
Yeah, goodbye.